let's start by defining what is an insurance contract. An insurance contract, basically, we know is a contract which is entered into between two parties. So these are contracts which is entered into between two parties. We have the first party who is called the insurer. And basically the insurer here, this is the same with the insurance company. This is the same with the insurance company. And then we have the other person who is called the insured. And basically this contract, what happens is that the insurance company or basically the insurer basically undertakes or maybe commits, basically the insurance company commits, I hope my video is clear from your side. I hope my video is clear from your side. Yes, I hope my video is clear from your side. I can see it's not very clear. I can see it's not very, very clear. Yes, I hope now it is clear. Yes, so basically what I'm saying here is that this is basically a contract which is entered into between two parties, the insurance company or basically the insurer, and basically another person who is called the insured. And in this contract, the insurance company basically undertakes to compensate the insured on the happening of a contingency or basically on the happening of a future uncertain event. And now the insured on his part basically commit himself to be paying some periodical payments which are known as what? The premiums, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event. And this person on his part must be paying some periodical payments which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have the life insurance. And when we talk about the life insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, insurance or the life assurance. And therefore, the general insurance, this includes insurance businesses such as burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what we call the general what? The general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business, assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? to determine the financial performance of each insurance business, of each insurance business, of each insurance business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company, basically at the take to insurance business, maybe like the fire insurance, or the provide to insurance business, or fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing this, always we start with the incomes, or basically the revenue from each insurance business, the revenue from each insurance business. So the first, or basically what we know is that once you have insured a certain subject matter, you have to pay something called a premium to your insurance company. So this premium is one main source of income as far as these insurance businesses are concerned, the net premium. But in this case, we are going to look on how do we compute this. Maybe we will have working one. Basically, we look on how do we compute the net premium, because that is something which the examiner will not have given you. You have to compute that. And then now to this, and basically what we know is that if, for example, you have insured a certain subject matter, you pay the premium in advance. For example, you own a car, you have insured your car, you pay the premium in advance. Some insurance companies may tell you, can you pay this in 2 installments? So, but you pay the premium in advance. So therefore, we know that that premium which you have paid basically covers or basically the insurance cover for the next 1 year. For the next 1 year. So basically, much of the money collected by the insurance company or much of the revenue is received in advance. Now, this premium is only supposed to be recognized as an income by the insurance company once the period covered has expired. For example, if the insurance company has received premium of 1 billion, it covers the next 2 years. So that premium will only be deemed to have to be earned as an income once the 2 years are over, or basically 1 year is over. So therefore, you may see that out of these particular premiums which were received during the current year, you may be told that part of it was not yet earned because the period covered has not done expired. So what do we do to this particular net premium? We basically add the unearned premium balance brought down. So these are the premiums which were not yet earned in the previous year because the period covered was not expired. Automatically, the period covered by those premiums will expire during the current year because usually the premium you pay is for 1 year. So any premium which was not yet earned in the previous year because the period covered had not expired will be earned during this year. So therefore, these are the unearned premium from the previous year. And then to this we less the unearned premium balance carried down. So these are basically the premiums which were received during the current year. These premiums which were received during the current year, but because the period covered has not expired, they have not yet been earned. So they should be deducted from this. And then now to this, we add something known as the commission on reinsurance ceded. Also, I'll be able to explain something to do with that. Let's just put it as a note there. Yes, I'll be able to give a note for that. I'll also be able to give a note for that. So, and then we get the total here. We proceed and we less now the expenses. And the expenses which we less here are basically the expenses specifically relating to each insurance business because they are general expenses. The general expenses to the insurance company, we take them here to the general income statement. But basically what we record here are the specific expenses relating to each insurance business. For example, in this case, you may be given some legal costs associated with each insurance business. We may also be given bad debts, which were written off. Budget written off, these are maybe the premiums which the customers declined to pay. We may also be given the management fee for each insurance business. We also have something called the net claims. In fact, this is basically the main expense for each insurance business. So once we have various individuals who have insured their subject matter with the insurance companies. So, and maybe the event insured against have occurred, they go to the insurance company, they release a claim. You have insured your car, you have taken a comprehensive insurance cover, your car is involved in an accident, you raise a claim with the insurance company. So once you are paid by insurance company, that is an expense relating to that insurance business. So we are going to look on how we compute this. We will have a note on that, note three, yes. So, and then also there is something else here we should not forget, known as commission on reinsurance accepted. Commission on reinsurance accepted. I'll also be able to give a note for that. What we mean by that, yes. And basically we less all those particular expenses from our total revenue here, and basically we get something called the net income. The net income from each insurance business. The net income is basically like the profit from each insurance business. So this is basically how we prepare the revenue account for each insurance business, business. So I think before you look on how we prepare the general income statement, maybe I can just give explain some of these items, like one, the net premium. So how do we compute the net premium? Which will be taken to the revenue account? So we can say this is basically computed by preparing premium account. Remember, premium is basically what you pay as a person who has taken an insurance cover. So to the insurance company, this is the amount they receive. They receive. So how do we prepare this account? The premium account. So, and also assuming our insurance business is providing to insurance business, is involved into insurance business, that is basically fire and life insurance. Fire and life, we have two columns on both the debit and the credit side, the fire and life insurance. So in most of the cases, you'll be told that some of the customers or some of the clients have not paid their premium. So if you have not paid your premium to an insurance company, you have not cleared your premium to the insurance company is an asset. So therefore, you'll be given the premiums outstanding at the start, which basically we record here as an asset. The premiums which were outstanding at the end of the year, simply because it's an asset. Premium which you have not paid is basically an asset. Then you will also be given the premiums which were received. So an insurance company can receive premium either from the client directly, from the stock brokers, and so on. So therefore, the premiums which were received, the double entry, we follow the double entry, is debited in the bank and then credited in this account. So the premium which was received. And this premium can be received either from the clients, from the insurance brokers, brokers. Then on this side, still we have the reinsurance premiums which were received. On this side, we have the reinsurance premiums which were paid. So this is basically whereby I hope you know what is basically to reinsure. So assuming we have a certain insurance company A, this insurance company A, which has got a number of clients, this particular client have insured a number of subject matter with it, but this insurance company may feel that the risk insured with it are too much. If maybe something happened, it may not be able to pay. So this insurance company may make a decision, can we reinsure some of this risk with another insurance company? So insurance company B, maybe something like that. So this insurance company will be paying something called the insurance premium. And then this one can receive reinsurance premium from another insurance company. So this reinsurance premium paid, the double entry, we debit this account, we credit back. And then from there, what we do, we basically balance this account. The balancing figure, which is on this side, is the net claims. And the net claims is basically now what we recognize there. So that basically how we compute the net premium, So then the other note we need to discuss here is on this one. The commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance. Oh, sorry. Sorry. This one should be net premium, not net claims. Thank you, Mike. Yes, so that one should be the net premium, not the net claims. Thank you for that. Yes. Now, in this case here, what is the commission on reinsurance ceded? So first of all, to cede ground is basically whereby you accept that as an insurance company, the risk insured with you are too much. If all the claims are raised by your customers, you'll not be able to pay them. So you have ceded the ground. So therefore, what you do, you reinsure those particular sum of the risk with another insurance company. Company. So assuming we have insurance company A, this company may feel that the risk insured with it are too much. So it decides to do what? To reinsure some of them with the insurance company B. It is obvious that this company here will pay something called the reinsurance premium. So this company A, will pay something called the reinsurance premium. So this particular reinsurance premium, we said to the insurance company A, they are reinsurance premiums which have been paid. It is obvious that this company here, that is insurance company A, is giving insurance company B some insurance business. It's then fair for this company to pay some commission. So if I give you some business, some insurance business, you must give something in return, which is called a commission. So therefore, the commission which will be paid by this insurance company, and basically which is paid to our insurance company A, to this company we say it is a commission on reinsurance ceded. It's the commission on reinsurance ceded. To this insurance company is an income. So therefore, we can say this number one is an income, and number two, we can say it is computed. It is computed based on the reinsurance premiums which are paid. So the reason why it is important for you to note that is because in most of these particular questions, you'll be told that the commission on reinsurance ceded is 5%. 5% of which the examiner will not tell you. 5% of the reinsurance premiums which were paid. So if this company pay reinsurance premium of 2 million, there may be an agreement that this company will be paying a commission of 2%. So it should be 2% of the reinsurance premiums which were paid. Yes. So then from there, we can look on the other item here, the net claims. How do we compute the net claims? How do we compute the net claims? So the net claims, basically these ones are computed by preparing the claims account. The claims account. The net claims. The net claims. So in this case, we have to prepare the claims account. So remember claims, this is what now the customers, the clients of the insurance company want to be paid. Want to be what? To be paid. You have insured a certain subject matter, and maybe because the event insured against has occurred, you have raised a claim with the insurance company. So this one we have said to an insurance company is basically what? Is an expense. So equally in this case, we prepare this for each insurance business, assuming we have fire and we have rise. We have fire and we have rise. So in most of the cases, we'll be told, number one, there were some premiums, not premiums, sorry. There were some claims which were not yet paid by the insurance company. So the premiums not yet paid by the insurance company, this is the liability. So being a liability, the claims outstanding being a liability, that one will be the opening balance with this account on the which side? On the credit side. So the claims outstanding at the start, the claims outstanding at the end. What else do we record in this particular account here? The other item which we record here are basically the claims which were paid. You'll also be given the claims which were paid. The claims which were paid. So the claims which were paid, basically the double entry for that is what? The double entry for that would be to debit this account with credit bank. That is basically the double entry for that. Then the other item you may be given is what? Are the expenses relating to the claims. Expenses relating to the claims. Expenses which relate to the claims. And basically the expenses relating to the claims, those ones, they should be debited here. Those ones should be debited in this account. What is the double entry for those expenses? Because they were paid, we credit them in the bank, we debit them here. And then from here we do what? We balance this account, and the balancing figure, which will be on this side, is basically now what we recognize as an expense, in the revenue account. In the revenue what? Account. In the revenue account. So that's basically how we compute the net claims. We compute the net claims. So the other item maybe I need to explain here, number 4, is the commission on reinsurance. On reinsurance accepted. The commission on reinsurance accepted. Commission on reinsurance accepted. So commission on reinsurance accepted. So when we talk about reinsurance accepted, this we are assuming we are preparing this financial statement for insurance company A. This insurance company here may have accepted to reinsure certain risk or to reinsure certain risk of a certain insurance company, assuming we have insurance company C, and this insurance company has reinsured some of the risk with our insurance company A. So we say that is reinsurance accepted. So this company here will pay to our insurance company something called the reinsurance premium. But basically to our insurance company here, this will be reinsurance premiums which were received. So to our insurance company A, that will be reinsurance premiums which were received. It is obvious that because our insurance company has been given some insurance business, it must pay a commission. So this is basically a commission which is paid to our insurance company. So once our insurance company pay a commission, automatically that is an expense. So this commission on reinsurance accepted, one, this is an expense. This is what? Is an expense. And number 2, this one is computed. This one is computed based on. This one is computed based on the reinsurance premiums, which were received. Reinsurance premiums which were received. Because in an exam, what the examiner will tell you is that the commission on reinsurance accepted is maybe 2%, 5%, but he'll not tell you it is 2% or 5% of what. So it's basically upon you to do what? To know that this one is computed based on the reinsurance premiums which were received. So I think basically that's what you need to know as far as the preparation of the revenue account is concerned, specifically computation of net premium, net claims, the commission on reinsurance accepted, the commission on reinsurance what? Exceeded. Basically, that's how we do what? How we compute those items. Then, after preparing the revenue account, we have determined the performance of each insurance business. Then from there, we prepare a general income statement, or basically a general statement of what? Profit or loss. Now, this one, as the name suggests, is basically prepared to do what? To determine the performance of the entire insurance business. This one is not prepared to determine the performance of each insurance business, but this one is prepared to do what? To determine the performance of the entire insurance business. So we can say this is the prepared. This is the prepared to do what? To determine a performance for the insurance company. The performance of the insurance what? The performance of the insurance company. The performance of the insurance what? Company. So how do we prepare this? Quite simple. Quite simple. We take all the incomes of the insurance company, and one income of the insurance company will be the net income which was generated from individual insurance business. So we take into account those incomes. We add them, the net income from individual insurance business. We add any other income by the insurance company, like an investment income and so on. And then we list now the general expenses. General expenses are those particular expenses not relating to the individual insurance business, not relating to fire, not relating to maybe life insurance. And then from there, insurance companies also prepare the statement of financial position. So statement of financial position, we know this one is prepared to ascertain the financial position of an insurance company. We prepare this in the normal way. We take assets, which we classify into two, non-current and current. We record equity, and then the liabilities, and then the liabilities. So the preparation of this is just the same with the preparation of the statement of financial position for other what? For other insurance, for other companies, for other what? Companies. So I want us to do a question, and basically we're going to borrow a question from FAR. So remember this topic previously, it was in FAR, just like what I said in relation to the topic of banks. So this topic was previously examined in FAR, CP intermediate level, but basically it was taken to AFR, Advanced Financial Reporting. So we will definitely borrow a question from that. And I want someone to go to the link for, I know you have the link for the past papers. Someone to download and share this question. I don't know who will be in a position to do that very fast. You go to those links for past papers. I know you have them, and you download this paper from a file. September 2021, the question for a file, and you share that with the class WhatsApp group. September 2021, the question I want us to do is basically question 4B. Yes, so someone maybe to download that paper And please share that in the class WhatsApp group. Share that in the class WhatsApp group. Share that in the class WhatsApp group. Yes, I'm waiting for someone to share that paper from the from a file. September 2021. September 2021. Yes, is someone able to do that? Has the question been reshared? I'm waiting for that, for someone to do that. To share that paper. To share that paper. Yes, have you been able to get that question? I'm saying if you just need to use those links, the link for past papers. I know you have those links for past papers, for downloading the past papers. You go to that question for September 2021. Question number, you just share the entire paper. Yes, I can see the question has already been shared there. I can see the question has already been shared there by Diana. Thank you, Diana. Thank you. Yes. Okay, so let's go to that question here. Let's go to that question. Let's go to that question here. September 2021. And basically this is the question 4B. Question 4B. 4B. So what are we told here? What are we told? What are we told? The question reads, the following trial balance was extracted from the books of River Insurance as at 31st of July 2021. So we are given a trial balance there. We are given the premiums outstanding on 1st of August 2020. We are given the retained profit on 1st of August 2022. We have the share premium, ordinary share capital. We have investment income, account payable, management expenses relating to marine and fire. We have depreciation of non-current asset, direct asset remuneration, audit fee, freehold property, motor vehicle at net book value, equipment and computers net book value, furniture fittings net book value, financial asset, budget written off for marine for fire. We have the survey expenses on claims, equally for marine and for fire. We have the legal cost for marine fire, claims paid marine fire, claims outstanding for marine and fire, and an expired premium for marine and fire. We have the cash and bank balance, account receivable, direct premiums which were received, reinsurance premiums which were received, reinsurance premiums which were paid, and then we are given additional information about your total premiums of premiums outstanding as at 31st of July 2021 amounted to 14.4 and 6.4 for marine and fire, respectively. 2, the reserve for unexpired premium must be maintained at 100% and 50% of the net premium for marine and for fire insurance, respectively. 3, claims initiated and outstanding at the end of the year amounted to 7.2 for marine and 4.608 million for fire. 4, commission for both reinsurance ceded and reinsurance accepted is 5% of the premium. Number 5, provisions is to be made for the following: taxation, 4,152,000, ordinary dividends 5%, depreciation of motor vehicle 4.182, equipment and computer 2.16, Furniture and fittings 2.4. What are we required to do? We are required to prepare the marine and insurance revenue accounts for the year which ended 31st of July 2021. Roman 2, statement of comprehensive income for the year which ended 31st of July 2021. And Roman 3, we are required to prepare the statement of financial position as at 31st of July 2021. So we will start with what is required in Roman 1, and basically we are required to prepare the marine and fire insurance revenue accounts. So let's start with that. We start with that. Basically here we will have the revenue accounts, and basically in this case, remember you have said that this account is prepared using a T format. Sorry, not T format, but rather a vertical format. Format. So here we will have our two insurance businesses, and that is marine and fire. I hope you can also be able to see that the figures we are given there are in thousands of shillings. So what we start by recording here are the revenue, or basically the incomes. The revenue. Now, remember, we have said that the first revenue which we start with is basically the net premium. So net premium automatically, this one is not given. We will have a working as far as that is concerned. And then to this, we have said we add the unearned premium at the start of the year. Now, these premiums which were not yet earned at the start of the year, they can also be known as the unexpired premium. Unexpired what? Premium. So because in our question here, we are not given an unearned premium, we're given something called the unexpired premium. Unexpired premium, these are premiums whose period has not expired. So we have said to this, we add the unearned premium. In our case, that one is known as the unexpired premium. Premium basically at the start. That one should be added. And then to this, we less the unexpired premium. The unexpired premium at the end of the year. I think, first of all, we can record this one because it's given in the trial balance. I don't know whether you can see the unexpired premium at the start. That one is within the trial balance. In the trial balance, we are given the unexpired premium at the start. Can you see that? Somewhere down there. So the unexpired premium at the start for the first insurance business was 46,080, and for the other insurance business, this one was 24,000. I hope you can see those figures. So automatically, this one is not given, but we're given some information in relation to that in note number 2. Can we go to note number 2? In note number 2, we are told the reserve for an expired premium must be maintained at 100% and 50% of the net premium for marine and fire insurance business, respectively. So this one will have to be computed. And actually, we are told for marine will be 100% of the net premium. We have not yet computed the net premium. And this one will be 50% of the net premium. We need to compute the net premium. And basically, to this, we have said, then we need to proceed. And basically, we do what? We also include the commission on